Today I want to talk about what we call kiddie tax. Really what that is taxes for minors. And they have some special rules. The whole reason for these rules are the wealthy try to pass income to their kids as much as possible to avoid estate taxes or inheritance tax and stuff like that, or as ways to minimize their own taxes. Um, and so the IRS has passed some special rules, and actually the rules were changed as part of a negotiation between Trump and the Democrats when he was in office, and he passed the Tax Act of 2017. And so what we have is we have two sources of income for children. We have passive income and we have active income. Same thing as for adults. Well, passive income is the idea of like dividends, interest, and capital gains, meaning money's making money. And then we have active income, which is like W-2 wages or running your own business or something like that. And the Tax Act of 2017 has separated the way these things are taxed for minors. The nice thing about minors is they're never subject to Medicare and Social Security tax. So active income or W-2 wages can be very beneficial when paid out to minors. And this is what we hear a lot of. A lot of people are told, oh, you should make your minor children employees of your company as a way to save taxes. And that is true. Uh, but there is some high risk involved with that. And so first, let's talk about the benefits of that strategy versus the risks. So if you want to make your minor child an employee of your own company, the benefit is that you can pay them up to the standard deduction rate and they won't be charged any taxes. So the standard deduction rate for the single standard deduction rate for 2023 is $13,850. So we'll just round up to 1,400 for easy, or 14,000 for easy math. So the idea is that you could employ your minor child and pay them up to $14,000 for the year, and they're not going to owe any tax. They're not subject to that Medicare and Social Security tax like you are on your own wages, or self-employment tax like you are if you're running a sole proprietorship. So you instantly save that 15.3% in payroll taxes on them. And then because they are, you can pay them up to $14,000 in wages, then that gets offset by the $14,000 standard deduction, and they still don't pay any income tax. So you pass $14,000 of income to your children without any taxes, and then it's counted as a business write-off for your business. So if you are in the 40% tax bracket, which is the highest, $14,000 times by 40% will be approximately $5,600, $5,600 in tax savings for you. So you save $5,600 in taxes, your kids pay no taxes, and you're able to transfer that $14,000. Okay, so here's the risks. The biggest risk is with the IRS and the Department of Labor. So this is a huge red flag for the Department of Labor and the IRS, because a lot of people like to pass income as much as they can to their children tax-free. So it's a great strategy, which means it can be high risk and result in an audit. Now, if you want to do it, that's fine, but you do have to keep very good records, very good time records, the same as if you were hiring a traditional employee. So you have to have a good time log that says the date, the number of hours that they worked, and what they worked on. And the reason why we have to know what they worked on too is because then you're subject to the next rule, which is wages have to be reasonable and fair, right? So you're not going to pay a 5-year-old that's taping boxes shut to ship or shredding paper $300 an hour, right? Like that's not reasonable, nor is it fair. So you have to compensate them according to the work that they're doing based on what would you pay somebody else that's an adult to do that same work. So like shredding paper should be maybe minimum wage. Shipping should be minimum wage. maybe up to, if they're older teenagers and they're able to like maintain inventory, track inventory counts, or they can do web design or marketing, or graphics design. Teenagers are very good at social media. So I actually use a teenager to do my marketing, right? And it's a way to pass income to them tax free for them and lower my taxes. But I keep a very good log and I'm paying her a fair wage based on the work that she's actually doing, which would be the same wage that I would pay somebody just over 18 or a college student or a third party unrelated to me. I would pay them that same amount. That way it will hold up in an audit with the Department of Labor and with the IRS. Department of Labor will come in and say that you're, come after you because you're not paying them enough or you're overpaying them. And there's issues with the Department of Labor. That's more of an attorney's realm because it's not taxes. So I can't really go into a lot of detail about that. The threat from the IRS is they're going to come in and say, you are just passing income to them if you're paying them more than fair. And then they will revert that back to you as dividends, meaning now you have less expenses. You're going to owe additional income taxes with associated penalty and interest because you've lost an expense. So that's the biggest risk. The next risk with paying children is you have to actually give them the cash that they earned. Now you can do that in multiple different ways. So if you're going to hire a minor, that is your own child, to work for you, and you're going to pay them $14,000 a year, they have to receive that $14,000 in some form. Now that could be you actually are writing them a check and giving them money like you would any other employee. That could mean that you're opening a college savings account for them. You're opening an investment portfolio for them. You could put them to work and claim it as their allowance, and then the rest of it goes into a savings account. Because the issue is as soon as they turn 18, you no longer have what we call trust, or you're not the person that is controlling their money anymore. So you're the trustee of their funds until they turn 18. At the point that they turn 18, you're no longer their trustee, and they have a complete authority over the money that they've earned. And we see this happen a lot in like child actors. So we all see in the news every now and then a lawsuit where a kid just turns 18. They were making millions as a child actor. Well, all that money's gone because mommy and daddy spent it on $600,000 cars and multi-million-dollar homes or whatever, and they took all the money from the child. Then when the child turns 18, they sue mom and dad. And it's because they earned the money, and so you have to give them the money. So the money has to be available for them as soon as they turn 18. So if they have earned $14,000 for 15 years, let's say you start working them, let's say you start working them at 5. So 18, that's 13 years. And if they're making $14,000 a year for 13 years, that means there has to be $182,000 available to them plus interest the moment they turn 18. And that's a lot of money for a kid that age. And so you have to consider the risks associated with that too, that they're going to want their $180,000. And it either has to be that you have no control over them at that point. If you have an investment account where you've been saving up money for them because you put them to work for you, you have to give them access to that investment account the moment they turn 18. Now, obviously, you have relationships with your own children. I'm just telling you the risks. So the idea is you would hope that you could give a kid that's smart enough not to blow $180,000, or you're able to give it to them over time as they go through college and start their own business or buy their first home or whatever, right? Like, so maybe you're able to still maintain some control over that. But the risk is at 18, that's their money. You're no longer the trustee over it. All right, so that's active income, working as a W-2 employee for you. Okay. Passive income. So this means like you could make your children a shareholder in your corporation or your LLC. This is a great way to start passing ownership of your business to them while they're still young without causing capital gains tax over time. Example, if you were to say, hey, I'm retiring, I'm passing my entire company over to my child, technically, you have to do a fair market sell of stock to them, which could result in capital gains tax for you on the sale of shares in your company, regardless of whether there's actually cash exchanging hands. Now, when you do that, there are discounts that we can use. For example, this is a privately held company, so we have a discount for marketability. Ownership and control, you could be giving them minor interests in shares in the company to begin with, and so they have no actual control over the company, so that discounts the fair value of the stock too. So there's ways that we can do that in the future, or you can start passing them ownership now while they're minors, to slowly build their equity in the company so that when they're actually capable of taking it over, they can without as much capital gains tax for you. Now, the issue with that, so that's the benefit. The benefit is you start passing passive income ownership in your company to them at a younger age, which will lower your taxes, or will pass them dividends and ownership and taxable income to them, which will lower your taxes. Now, the problem is let's say you give them a 2% ownership in your company, and your company makes a $100,000 profit. Well, $100,000 profit times 2% is $2,000. So that means your children are going to owe tax on $2,000 of taxable income that they didn't actually receive in cash. Now, you might also, if you take a dividend of $100,000, that means that dividend, $2,000 of it is owes to your kids. And then it falls back into that same, I'm the trustee over your funds until you're 18 type thing. So anytime you take a dividend and they are an owner in your company, they have to take an equal dividend based on ownership percentage. You have 98%, they have 2%. Well, the rules on passive income for taxes on kids is significantly different. So let me go ahead and share my screen here. This is a pretty good explanation of it. Okay, so we're looking at a Google search that I did just so that you can see the numbers. So on passive income, so they call it unearned income at this website. Basically, it's like I said, interest, dividends, capital gains, taxable income out of a business that they're not operating. So the first $1,200 of a child's unearned tax is free. So that's basically like saying, okay, this is the standard deduction for passive income. So it's only $1,200. So if you've passed them, like I said, a 2% ownership and your company makes $100,000, $1,200 of it's going to be tax-free to them, which means it's really only saving you, if you're still in that 40% bracket, it's still only saving you $500 in taxes. Then the next $1,200 is subject to the child's tax rates. Now, child's tax rates are actually not as nice as your tax rates. So child tax rates fall into what we call the trust tax rates. And that means the tax brackets go up at a very small amount. So for example, an adult's tax rates for married filing joint 2023 tax brackets. See if I can just find it real fast here. Pulling it up in a Google search. All right, here we go. So here are married filing joint tax brackets. So the maximum tax bracket for married filing joint is $600,000 and almost $700,000 for 2023. For single, $578,000. So you have to have that much in taxable income before you are taxed at the 37% bracket. Well, for the child tax rates, because it falls underneath the trust tax rates, that maximum bracket hits at about $13,000. So it goes up very fast. And so a kid might be paying 40% taxes on something that you would only be paying 20% taxes on. So that's like it's actually making a child an owner in a business these days is not really beneficial at all. Now, not for tax savings. It is for passing ownership in a company, get them involved, stuff like that, get them involved in the company and have them have an ownership percentage in the company, which can teach them things, make them have an invested interest in the company. That's great, right? Like if that's what you're going after, do it. But when you actually are passing them ownership, they're going to get taxed more on that because they're a minor than you would by just keeping that income under your belt and paying the taxes on it yourself. So ownership really isn't any beneficial for tax savings. Wages can be, but there is high risk of audit because it throws up some pretty big red flags. So a lot of people are always like, hey, I want to employ my child. I've heard that there's some great tax saving strategies for that. And there really is, but you have to cross your T's and dot your I's when you do it because there's a high likelihood you're going to get audited. And then the next thing is if you cause an audit from paying your child, that can open the doorway to audit of your entire business, right? Like your entire tax return. They might only be coming in to audit the wages to the child. That's what threw up the red flag. So that's what they're looking at. But because they're already looking at things, they might say, hey, we also want to look at these other things. Now we're going to be defending all our tax stances on all the aggressive stances that we take. And I'm not saying we'll win or lose those. I'm just saying an audit takes time. And time equals money, whether you're defending yourself or you're hiring somebody to do it. So you have to keep that in mind as well. Like you might win the entire audit, but it could cost you $5,000 in time to defend that audit. So that's the thing is like you have to offset the benefits to the risk. The benefits of giving wages out to your child if you're in the highest tax bracket could save you over $5,000 in tax. Is that worth it? Because now we're saying, well, if you're in the highest tax bracket, you're probably making almost $500,000 a year in taxable income. Whereas what's probably happening for most of my clients is if you're paying your child $14,000, you're probably really only saving about the 20% tax bracket or 25%. That's only $2,800 a year in tax savings. Is that actually worth the risk? So keep that in mind. The other thing I want to talk about is actual traditional employees for your business. So the biggest issue here is if you hire somebody to be a traditional employee, you're going to be subject to Medicare and Social Security tax. So you go out, I always tell everyone, hire independent contractors. And if they're working from home, setting their own schedule, telling you when they want to take vacation, providing their own tools or equipment or computer or whatever it is, that any of those things means you have less control over them and they are very easily identified as an independent contractor. The nice thing about an independent contractor is they can take all the same tax strategies that we take for ourselves. They set up a business, they become an S corporation, they minimize their payroll taxes on themselves, that Medicare and Social Security tax, and they can get aggressive on their business expenses. They can take a home office deduction, they can write off clothing, they can write off the car, they can write off fitness equipment, right? Like, so there's all these things that they can do as an independent contractor that they can't do as an employee. So we turn a bunch of those personal expenses into business expenses for them. And you save on the payroll taxes. So we love independent contractors. If somebody wants to be a traditional employee, we come into two problems with that. One is you might pay them $20,000 for the year. Let's say you pay them $20,000. Well, cash flow, you're going to owe 15% of that to the IRS for payroll taxes. Now you're going to withhold half of that from their paycheck, and you're going to pay the other half out of your paycheck, out of your actual bottom line. So at $20,000, payroll taxes is 15.3%. So total payroll taxes is $3,000. You're going to take half of that yourself. So you're paying an extra $1,500 on top of what you're paying this person in wages. So you pay extra to have them as an employee. Plus, they're having that same $1,500 withheld from their paycheck when we could minimize it significantly more if we were treating them as a subcontractor. The other issue is we're taking a lot of expenses in your business as employee benefits because you're an employee of your own company. For example, maybe a gym membership, a health and wellness plan, writing off all out-of-pocket medical expenses. Okay, out-of-pocket medical expenses is a great example. So the rule here is we cannot discriminate on employee benefits other than in health insurance premiums. That's the only one we can. So if we're taking a medical reimbursement plan as an employee benefit because you are your only employee and you go out and you hire a full-time employee, and I say full-time specifically because the rule is you can't discriminate on employee benefits. That's if they are what we call a fully vested employee, and typically that means you're working 30 to 40 hours plus a week and you've been with the company at least 3 months. That's usually what it means. Every company defines it a little bit differently, but the term is fully vested, and usually it's 3 months at full-time employment. At that point, you can no longer discriminate. So if you're giving yourself a medical reimbursement plan where we're writing off 100% of your out-of-pocket medical expenses, that means you have to provide that same benefit for them. Well, what if they are having a baby and they don't have health insurance? Well, now you have to pay that $10,000, $20,000 doctor bill for them because you're taking that same employee benefit. So if you're going to hire full-time employees, I'm not telling you you can't. There are specific things we have to do to make sure that we're still able to take all your expenses. And part of that is we're going to end up changing the ownership structure of your business. So whenever possible, always just hire independent contractors, and it makes things so much easier, and everybody's saving the most in taxes. To be frank, if somebody tells me they want to be an employee instead of an independent contractor, I actually am very, especially since I'm a tax preparer, I very seriously consider whether I actually want to hire that person or not. So that's just my personal take on it. But all right, quick summary on Kiddie tax. If you're going to pay them wages, you can pay them up to the standard deduction rate, which for 2023 is about $14,000. That's a complete business write-off for you, no additional taxes for them. So it's going to save you at your tax bracket rate. But if you do that, you have to keep good timekeeping logs because there's a high risk of an audit. If you're going to make them an owner in your company, they're going to be subject to different taxes than you are, and it's actually probably going to end up costing you more at their tax rates than at your own tax rates. You're going to hire traditional employees, try to keep them as part-time, which means you can still take your employee benefits for yourself and you don't have to offer it to them. Or if they want to be, if you're going to hire full-time employees, let's have a conversation about how to restructure your business so that we can still take those employee benefits for you, but not have to provide them to your traditional employees. All right. Thank you. And I hope this information is helpful.